Okay, let's get started. Hi, everyone, and welcome to another quarterly update and Q&A brought to you by the team at Apollo Crypto. I'm Henrik Andersson. I'm the co-founder and CIO, and today I'm joined by Pratik Kala, our Head of Research Portfolio Manager. Hi, Pratik.
Good to be here, Henrik.
For anyone new, Apollo Crypto is a multi-strategy investment fund manager that is headquartered in Melbourne, and we invest globally. We have more than 7 years successful track record. We have 3 active funds in the tokenized strategy, focus solely on managing crypto asset and strategies on behalf of wholesale investors, family offices, and fund of funds. Thanks very much for everyone attending today. We do these webinars on a quarterly basis, and we also publish a weekly newsletter along with long-form research. And you can sign up to our newsletter at apollocrypto.com. The purpose of this webinar is to inform our investors and followers and to provide general update on crypto markets and our funds. And as a reminder, this is a general discussion and it's not to be taken as financial advice. Please do your own research when considering an investment in the crypto markets. As always, we're happy to take questions from all of you. So please submit any questions you have through the Q&A feature and we'll answer them at the end of the webinar. With that said, let's get started. I'm going to share my screen. Hopefully you can see some slides now. So we'll start with the agenda. So we'll do a recap of Q3. Q3 was a strong quarter across our funds. And we'll talk about our funds and some other narratives in the market currently, like the revenues that are generated in DeFi, traditional financial institutions coming on board, as well as stablecoins and regulations. And then we'll end with outlook for crypto and macro in general and our portfolio positioning before we go over to Q&A. So this is the market year to date, looking at Bitcoin, Ethereum, SX 200 here in Australia, as well as the S&P 500, which is the orange line. You can see Ethereum had a very big drawdown in the beginning of the year around the wars with the tariffs, hit the low during the April and then bounced back. And currently, we are in a period where stocks are at all-time high. Gold has performed strongly, and crypto has rebounded from the lows in Q1. On the macro side, the highs in the equity markets have been partly driven by strong earnings, but also easing from central banks. The Fed has cut rates 2 times this year, and the market is expecting the Fed in the US to cut the rates again in December of this year. And we'll talk more about that later in this webinar. As I mentioned, we had a strong performance in Q3 across our funds. Our Australian Unit Trust, which is the Apollo Crypto Fund, was up 21.2% in Q3. That is more than Bitcoin. It's also more than our benchmark index, the S&P Cryptocurrency Broad Digital Asset Index. So the Apollo Crypto Fund is a diversified and concentrated portfolio. Really, all our best ideas across the crypto asset markets. The vast majority is in liquid crypto assets. And we've had, as you can see from the chart here to the right, a strong performance since our inception in 2018. It's really designed to be your one vehicle for crypto exposure. It includes Bitcoin, Ethereum, as well as altcoins. The Apollo Crypto Frontier Fund is a fund that's focusing on solely alternative assets. And what we mean by that is all crypto assets outside the 2 largest ones, which are Bitcoin and Ethereum. And this fund had a strong Q3 as well, up 18% in the quarter. And it's really a concentrated portfolio. Bitcoin and Ethereum, mostly liquid tokens again, with some upside from what we consider high quality primary deals. It has a higher volatility, but also potential higher upside than the Apollo Crypto Fund. And it's a USD denominated fund, and it's a Cayman Island fund. You can see some of the assets in the portfolio here to the right. Maple, Solana, Hyperliquid, Aave, Euler, Sky are some of the assets we have in the portfolio right now. The third fund that we advise is the Apollo Crypto Market Neutral Fund. It has had an exceptional strong Q3 as well, up 10.1%. This is a market neutral fund that uses mainly stable coins to achieve what we call an on-chain yield. It's a BVI fund, it's a US dollar denominated fund again, with a target return of 15 to 20% per annum. Since its inception in 2020, it has achieved 1.1% average monthly return. And for the last couple of years, it's had 100% positive months. So it's very different than the first two funds. It's a very stable fund. It's not affected by the daily movements of Bitcoin and Ethereum, for example. So extremely strong Q3 for this fund. We also have a new offering together with Midas. So Midas is a European platform that has issued a tokenized tracker certificate that is based on an Apollo yield strategy. So this is a tokenized on-chain yield strategy that is available in selected markets, and you can find out more at midas.app/mapollo if you're interested to find out more. By having a tokenized yield strategy, you can do things like lending, borrowing against this asset. There's also fixed yield opportunities in DeFi. As a similar risk and target and return target like the market neutral fund, 15 to 20% net return with a low volatility. With that said, I'll hand it over to Pratik to talk about some of the things happening in crypto at the moment.
Thank you, Henrik. Now I'd like to begin with how far crypto's come since at the start of this year. We'll talk about revenues first. Historically, there were many crypto protocols that generated significant revenue, but they were never able to distribute it to token holders. And the reason for that was primarily hostile regulations. I think we've talked about regulations here for many quarters, but effectively, if you were a crypto protocol, you generated a lot of revenues, you wanted to make token holders whole or give it back to them, there was no proper legal way to do it. A couple of founders actually domiciled their protocols outside of the US, but if they ever entered the US back in the 21-22 era, they were handed out subpoenas. So it's incredibly difficult for this entire industry to pass revenue back to its token holders in any meaningful way. Now, this has all changed since the start of this year. We've seen a swathe of positive regulatory frameworks that have now allowed the majority of these projects that are making revenues to pass it on to token holders. I'll talk about some of the top earning protocols out there today and how they're distributing revenue back to token holders, because for crypto, in traditional finance, revenue generated back to token holder or equity holders is via dividends or stock buybacks. And in crypto, obviously, the stock buybacks mechanism is used, or as they call it in the industry, buyback and burn. The most profitable protocols in crypto are on the list on the right, and some of them have already started to pass revenue back to token holders. The most significant one of those is Hyperliquid. It is a perpetual DEX, or decentralized exchange, and it generates USD $1.4 billion in fees per year, and is committed to buy back its token using 97% of all proceeds. So it's very significant. By way of comparison, this revenue pales in comparison to what the ASX's revenue pales in comparison to what Hyperliquid makes. And ASX definitely doesn't use 97% of its profits to either distribute as dividends or buy back their own stock. So we're seeing some of these enormously scalable crypto protocols finally distribute revenue back to token holders. The second one, for example, is Pump.Fun. It's gone even further and currently uses 100% of its revenue to buy back its token. Some people may wonder, 100% of its revenue, how does it make profit? How does it fund its team? These are various different ways of how protocols attract capital, and it's just a way of capital formation within the crypto markets as well. So it currently uses 100%, has been doing for the past couple of months, and then this can change in the future, but we are seeing literal revenue being generated and distributed back to token holders. Syrup, again, or previously known as Maple Finance, also has increased its buyback. So it started off from 20% of all its revenues. Now it's increased it to 25%. And as they grow their annual recurring revenue, they want to buy back more and more of their tokens. So it's a refreshing change in the industry, where we are seeing real cash flows and real users and revenues being distributed back to token holders by the way of buybacks. Buybacks and burns in some cases as well. For people that don't know, there's a way to buy back, and then there's another way to buy back and burn. Burning over here basically means removing from circulation. So basically making the token deflationary over time. I expect this trend to accelerate. In fact, one of the biggest protocols ever, Uniswap, one of the OG protocols, announced this morning, just 3 or 4 hours ago, that they too are going to start a fee switch and buy back and burn their tokens. So this trend is only starting, and I think more and more of these protocols will continue buying back their tokens, which is going to be phenomenal.
And Uniswap, we can mention, is a US-based protocol. So ties in what you said about the regulation in the US now enabling this. I think they've been very hesitant doing this, but it's starting to happen right now.
Exactly. I think Uniswap's fee switch was being discussed for 4+ years, but because they were US domiciled and regulated, they were very afraid to do anything. And finally, as of this morning, they've put in place a structure by which they can buy back their tokens. So it's all moving in the right direction for the entire industry to not only generate revenue, but distribute it back to token holders. So it's great to see.
Yeah, it's really positive.
Yeah. Now, obviously, everything in markets is about incentives as well. And we just talked about revenues for crypto projects and token holders. But another angle of this is traditional finance. They have been incentivized like never before. Now, on the right, you'll see the headline. It's actually from Bloomberg. BlackRock's most profitable ETF is a $100 billion Bitcoin giant. And that is correct. BlackRock runs a range of ETFs globally, but its most profitable product is actually a Bitcoin product. And the chart below tells you the speed at which the Bitcoin product gained AUM. So those are all the BlackRock products in the bottom right. And you'll notice that IBIT, which is the BlackRock Bitcoin ETF, it only took it 435 days to accumulate $100 billion. I believe BlackRock charges 25 basis points as fees, so that's clean $250 million a year on a Bitcoin product, and it is, again, the most profitable product. So BlackRock obviously began trading in 1988, and it's 2025 now. That's 13.5 trillion in assets, and it's funny that it's only been 2 years since they launched a crypto product, and it ends up becoming their most profitable product. So incentives shape behavior, and Wall Street loves a profitable product as well. So the distribution channels of money coming into crypto has opened up. This is only BlackRock generating money, but also Fidelity, VanEck, and all the other issuers are making significant amount of fees on some of these Bitcoin ETFs, and they are very incentivized to continue writing about these assets, talking about it to their clients, and convincing other, high net worth, private wealth individuals, sovereign funds, and others to take exposure to this asset class. So a couple of years ago, it was just people like us talking about the beauty of crypto and the future. And now we have the cavalry here with the traditional finance, sales, and marketing machine as well. So we expect more money to come into this asset class as well from here on. The profits of these issuers have also pushed them to create other ETFs. So it started off with Bitcoin, but we do have Ethereum ETFs. We have Solana ETFs. We have a bunch of altcoin ETFs as well. And some of them have also been approved to turn on staking. So for people, again, that don't know, you can hold for the likes of Ethereum or Solana and generate anywhere between a 3 to 6% yield denominated in the token because that's how the protocol is designed. So again, historically, these staking mechanisms were not approved within an ETF wrapper, but now they have been as of last month. So that should all continue pushing the envelope to attract more institutional capital directly into the space, into regulated instruments. And finally, some players can only access ETFs if there's also a deep options market. And some people only do spots, some people only do options, some people like to do other types of derivatives. And if you log on and look at the options chain for IBIT and other Fidelity products, they're very deep, heavily traded as well. So it basically allows every participant in the market to participate within the crypto markets and have no sort of excuse to stay on the sidelines in this case. So really phenomenal things. Traditional finance is finally on board in the industry as well. The next slide is very interesting as well and very important. Today, stablecoins are about 300 to 500 billion, depending on how you want to count them. But the US administration is committed to making it a $10 trillion market. We believe strongly that this is going to happen as well because stablecoins are just better rails. So you'll notice on the right, it's a tweet from Henrik actually, that Walmart's launching its own stablecoin, Amazon is launching its own stablecoin, Bank of America is launching its own stablecoin, and there's at least 20 other people that have issued or talking about launching their own stablecoins, including payment giants, e-commerce companies, banks, corporates, and even obscure technology companies as well. They're also launching their stablecoins in the AI era because they believe it's a better way to move value around instantly with instant settlement. So I believe stablecoin is actually step one in the journey of tokenization of all assets. And it's the simplest way, but this is the beginning of that. So an example I always give is even today, if you had an Apple stock in your share portfolio and you wanted to transfer it to somebody, it is close to impossible to actually do that without friction. Now, in the future, when it gets tokenized, you should be able to just send an Apple stock to anybody in the world using WhatsApp messages. So basically just attach it. It's a token. Using WhatsApp, you can transfer a share or a stock. I mean, it seems unbelievable today, but that's the future that is being built at the moment. And stablecoins are step one, and we will be tokenizing all the assets that will be coming online. And Crypto Rails naturally is the home to host all of these assets. It has been well tested and built over close to a decade now across since the beginning of Ethereum. So the rails are ready, and now the regulations are coming around. So it's looking very positive to get more and more assets on chain, starting from stablecoins. And some people have concerns around public and private chains. So if you've been following the market, we have public chains such as Ethereum and Solana in our portfolio. But there are private chains that are coming up, such as Tempo from Stripe, and Circle's launching its own stablecoin chain called ARC. This is, I think, people think that's bearish. existing stablecoin chains that existing layer 1 protocols that we have. But I take the opposite view. It's actually very healthy, and it's a rising tide that lifts all boats. I don't see a world where there'll only be private chains or only be public chains. They'll talk to each other, they'll work together, and it's only better that we're going to have both private and public chains to tackle the various different use cases different enterprises have. And US dollar stablecoins dominate the market today, but we are seeing Japanese yen and the British pound and a whole bunch of other stablecoins come onto the market as well. So $10 trillion is just the beginning, but I think eventually stablecoins are the primary means of transfer globally for value.
Yeah, that's right. And part of the reason I wrote that every bank, every fintech, every social network, every retailer will have a stablecoin is the profit motivation again that you spoke about on the previous slide. Tether, which is the largest issuer of stablecoins globally, made 13 billion in net profits last year, and it's most likely the most profitable company per employee in the world. I think they have between 150 and 200 employees. So other players in the market see that and want to get in on the market.
Yeah, that's right. And we'll talk about regulations. It's a little bit of a boring topic usually, but it's good to refresh what's happened since the beginning of this year. The US administration is very, very set on making America a crypto superpower. Donald Trump and the admin, Scott Bessent, has mentioned that very frequently. In fact, every month you'll see them putting out something around making America the digital assets capital and a crypto superpower. Now, this is interesting. I think there was some commentary from China and Russia as well, directly from Putin, I believe, as well, around how America is embracing crypto and whether or not they should too, or they should not. I mean, there are different views on that. The positive side on this is still that America is embracing it, obviously, because America still today has the deepest capital markets in the world. And if they're embracing it, I expect the G8 and G20 countries to fall in line over time. So regulations, again, were holding the entire industry back. America is leading the way, and I believe many other countries in the G8 and G20 will follow suit in due time. So again, it opens the market up to more and more participants globally. A quick review of all the regulations that have passed since the beginning of this year. The Genius Act was passed, which is pro stablecoins. A strategic Bitcoin reserve was passed. The administration hasn't added Bitcoin to its reserve or newly acquired Bitcoin to its reserve, but it's set in place a framework that it could do that in a budget neutral way. So again, it's very positive. SAB 121 was an accounting method which was repealed, and now it allows all the banks to provide digital asset services. So I expect you to be able to get a Bitcoin-backed home loan or a crypto-backed home loan in the near future. The National Cryptocurrency Enforcement Team was disbanded. There's a dedicated crypto task force in the US to support the entire industry. And the final bill, which effectively will allow every single institution that is still questioning whether or not to participate in the industry to come in, is a Clarity Act. We expect that to pass sometime soon. They're already discussing about the details of this in the Senate. And what this act is at the moment is effectively a market structure bill, and which delineates the responsibilities of certain crypto products between CFTC or the SEC and so on. So any participants that are still questioning how to enter the market or how to produce products or how to pass revenue or anything in this market, it's going to be clarified when the Clarity Act gets passed. And it's quite aptly named, actually, the Clarity Act, which allows everybody to come in. And again, macro outlook, there's no commentary here. I just want to show two charts. The first chart is the M2 money supply. You will see that chart begins in 2008, and it's been going up. We were at about 6 or 7 trillion. We are at 22 trillion now. So we have tripled the money supply since 2008. You'll see a little dip in 2022 and 24, and even to the early stages of 2025, which was people thinking the money supply is shrinking. And so that's bearish risk assets. And towards the end of this year, now 2025, this chart is as of yesterday, is ticking back up to a new all-time high. I think we can all debate whether or not money supply will increase or decrease, but I think largely after the failure of Doge and everything that's happening in the US and the new potential $2,000 stimulus checks that Trump wants to hand out to every US citizen, I think this continues going up. And as the money supply goes up, historically, it has shown that some of it chases risk, and it comes towards crypto. So Bitcoin and M2 money supply overlaid has a very tight correlation. So we expect that to come towards Bitcoin as well and the broader crypto industry. And the chart below this is actually even more interesting. This is the amount of assets in the money market funds. So again, this starts from 2008. We had $2 to $3 trillion in money market funds. We have close to $7.5 trillion today. That chart is also going up only. And if we believe that rates are going to come down, as we've seen historically, the assets in the money market funds tend to chase risk assets. Today, rates are still reasonably high. A lot of people are okay with 4.5% handle. But if we are coming on a rate cutting outlook, and I believe Trump's going to get his way next year by having his Fed chair nominations, and if rates come down, we also expect some of this money market fund money to come out. And this is just basically showing how much money is still being not only generated by the government, but also in money market funds that's sitting on the sideline that can potentially come into this space. And this typically changes risk further down the spectrum. And with the favorable regulations, crypto should be able to capture a lot of these flows. So the backdrop's also looking quite positive.
Okay, great. Just a reminder to everyone that you can put in your questions. We do a Q&A at the end of this session. So use the Q&A feature in the webinar to ask any questions as we go along. So crypto outlook, some of the current narratives, and we spoke about this. Revenue distribution is accelerating. US-based projects now feel comfortable redistributing revenues to token holders. So this is really positive. And especially for active managers like us, we're able to pick the assets that we believe will generate the revenues and also distribute them to token holders. And as Pratik explained, Clarity Act is the final piece of the puzzle when it comes to regulation in the US. So that's a really big deal. We got a stablecoin bill called the Genius Act, enacted in June of this year. The Clarity Act, which is the market structure bill, was expected to be passed before the end of the year, but it could spill into Q1 potentially with a shutdown in the US. But it's happening. So that's really positive for the confidence in crypto markets generally. And the tokenization that we spoke about as well when it comes to stablecoins. But this is coming to all kind of assets out there. If you, for example, listen to BlackRock, they're talking about tokenizing all kind of assets, everything from bonds to equities to money market funds. And stablecoins is the first piece of that puzzle. In the chart at the bottom of this slide, you can see the total value of tokenized assets. So it's really starting to accelerate starting last year and really accelerate going into this year. And this is excluding stablecoins. So these are all other assets. Stablecoins are growing exceptionally fast, but these are all assets outside stablecoins. So things like private credit, US Treasury debt, commodities. We're even seeing equities now on chain. So it's finally happening, bringing value onto the blockchain and leveraging the infrastructure that has been built in DeFi and elsewhere. So that's really a positive from some of the current narratives. When it comes to portfolio positioning, so our philosophy is to run a concentrated portfolio with high conviction ideas, really identify the revenue generating projects and those that can bring that back to token holders as well. And we think this is a really good market actually for an active manager that can identify those projects. This cycle is very different from previous cycles where everything was very correlated. Now we are seeing some specific altcoins performing extremely well, such as Syrup, such as Hyperliquid, and other tokens in our portfolio. And this is all driven by the revenue that these projects are generating. And we are focusing on liquid strategies, so less of the primary deals where you have to wait for a token generation event and then invest tokens over multiple years. We think the market to be in liquid strategies, so that's our focus. And we should say that all our strategies and funds are liquid by nature. We don't have any lock-ins. We have monthly liquidity across all our funds, which is quite unique in the crypto asset management industry. Across our portfolio, we're actually generating yield now. That goes for Bitcoin and Ethereum and Solana and all the other assets in our portfolio. And the yield we generate, we believe, is actually higher than the management fees charged in the funds. We are pretty happy with our ability to generate yield. Prateek, maybe you want to speak about some of the assets we have in the portfolio currently?
Yeah, sure, Henrik. And yeah, I want to echo Henrik's point on us generating yield across all the assets. There's a very simple way to generate yield, and you get 2.5%. And then there's better ways for the same, for close to zero risk as well, to generate yield across assets as well. We're seeing institutions like BlackRock and VanEck use these ways to generate it in their ETF structure. So I think that comes down to how well the manager knows the industry and pockets where they can generate that yield for effectively zero risk as well, which is provided by the protocol. One of those ways as well that I think we're very proud of generating very good yield, and as Henrik covered, potentially cover all of the management fees with that as well. Now, within the portfolio, some of the top picks, Hyperliquid, I think I've mentioned it. It is a clear category winner. It's buying back its token to the tune of 97%, using 97% of its revenues. You can have a look at a chart. It's quite an interesting chart. It started off at $4. I think it's at $40 right now. So, and it's only been about a year since it launched. So that TWAP, so to speak, or the buyback of its own token is what the industry loves. And really Hyperliquid is a gold standard to do that. Syrup, or previously known as Maple Finance, was bringing sort of traditional finance lending on-chain with transparency combined with DeFi composability. They too are aggressively expanding. They have partnered not only within crypto, but also externally in the traditional finance market, specifically servicing some of the digital asset treasury companies. And the profitability is increasing, and they're using significant amount of that to buy back its own token as well. Aave, I think, is the largest on-chain borrowing and lending market. So that's a blue chip that we've held for a long time and still very bullish going forward. Sky, or previously known as MakerDAO, is the largest on-chain stablecoin issuer. It also has significantly strong earnings and also uses a lot of its revenues to buy back its token. And Pendle is a yield protocol. This is more interesting for the interest rate derivatives people, I guess. But it's a very phenomenal product, and it is actually the forefront of crypto as well, as we're building products that traditional finance was gated by sort of institutions and investment banks, not available to the common people, now being on chain and available to everybody. So very exciting product as well. And finally, I think we're also proud to say that we don't have any exposure to the 10/10 event or the recent Balancer exploit. So 10/10, 10th of October, was an event where certain assets in crypto, not including the majors, they dipped anywhere between 30 to 90% in in what you could call as a flash crash before they restabilized. So a lot of our peers were impacted because of how they ran their books, and a lot of other participants were impacted. But we've been doing this for 7 years, and we are aware of these risks, and we typically never even we were not in any of the positions to be compromised in that. So very happy to say that we had no exposure at all on the 10th of October or the recent balancer exploit. Yeah.
Okay, great. I think that concludes the formal presentation, and we can move on to Q&A. I see we got some questions already, but if anyone has any more questions, please feel free to ask them in the Q&A feature. So we got one question: how did your market neutral strategy generate 10% in Q3? What was the main P&L contributor? At 10% in Q3 is really a phenomenal return for the market neutral fund. As I said, historically, it's been generating 1.1% per month, historically, on average since inception. And September was the best month ever for the fund. Pratik, do you want to tell the audience how we do that?
Yeah. So in crypto, there are pre-deposit campaigns to bootstrap new protocols from time to time. Now, through our network, we found out that a Tether-backed chain, which is called Plasma, was being launched. And if you don't know much about Plasma, it is effectively backed by some really great companies and funds such as Peter Thiel's Founders Fund, and Tether, the company which is the most profitable company in crypto, and a range of other funds. So what happened was, through our network, we determined that Plasma was running a pre-deposit campaign where effectively you just deposit stable coins, park them for a month or two, and in return, to support the network early, you get an airdrop of their tokens. There were mechanisms on how much you deposit and how much you're eligible to get in an airdrop. It was instantly oversubscribed, and it was a very successful thing. The team was, we were match fit and ready to deploy into it. So I think if you want to call it the war room, in order to get into the Plasma sale, you basically had to have everything lined up and be ready to click in 20 seconds, because in the allocation began with $500 million of stablecoin deposits, I believe, and it was filled in 12 seconds, I believe. So we literally, it was Henrik, myself, Juan, and the entire team, Quinn, everybody over there ready to be there. We knew when it was going to start. We clicked quickly and we got in. As a result, as being an early supporter of the project, we got an allocation to XPL, the token, and we believed in the XPL token to do really well, and we got it at a $500 million valuation. When the XPL token listed, it ran up to $8 billion, then $10 billion, then $16 billion in valuations. So as soon as we got it, because we're a neutral fund, we disposed of it. But that was, I believe, a 15 or a 20x on our initial airdrop amount. So that's how we led to a very phenomenal return to the fund. And the primary reason, again, for that is, we've been in the industry for a while, and we do get some really, really good deal flow. And then getting a deal flow is one thing, but being able to execute it is another. Again, a lot of our peers weren't able to click in and didn't have the infrastructure to get in 20 seconds. We did, we got in. And so the returns of that month in September were phenomenal.
Yeah, so this is called a pre-deposit vault, so they can be very profitable. There are also private deals, the market neutral fund that we participate in, where projects come to us for liquidity, and we're able to provide that, and they can guarantee a good return for us. So those are the kind of things we do in the market neutral fund. All right. We got a question as well about Uni that we spoke about, Uniswap, that just enabled the fee switch. Does the main fund still own it? We haven't owned it for a while. It's been underperforming quite severely. Now when they enable the fee switch, we'll have another look at it. So that's definitely on our radar, but we don't currently own it. And I think for the last year, we're pretty happy not to have on Uniswap. A lot of other tokens have outperformed Uni for quite a while. We got another question about the 4-year cycle. Does it still exist? So there are different opinions on the 4-year cycle. So the history there is that the Bitcoin halving cycle is 4 years, and historically, the sentiment in the crypto markets have been following that 4-year cycle. My opinion is that the Bitcoin halvings are getting less and less relevant as the inflation is at pretty low levels now. And also we have more institutional capital coming into the crypto market. So the nature of the crypto market has changed over the years. So I think actually we will not follow the 4-year cycle going forward. Crypto is, in my view, mainly a risk-on asset. So if you see equity markets doing good, for example, I think crypto markets should do well going forward. Of course, there are other things as well affecting crypto markets, like regulation that we spoke about, the big kind of secular adoption we see when it comes to tokenization, stablecoins, etc. But in general, I don't think we'll follow a 4-year cycle. Do you have a different opinion, Pratik, or what's your take on it?
No, I agree. I don't think the 4-year cycle exists anymore. The market structure has completely changed in the last year. 5 to 6% of all the Bitcoin held in the market is now held by institutions such as BlackRock and other ETF issuers, and also the likes of digital asset treasury companies like MicroStrategy. These guys are long-term holders, hodled forever type of people, and they are, when they sell, is probably more correlated to a risk on and off environment, and also things such as tax loss harvesting and other sort of implications on their investments. So the 4-year cycle historically was completely run by crypto native participants, and now a significant chunk of the market is now traditional finance and other hedge funds that have no concept of the 4-year cycle. They just started crypto about a year ago, maybe a year and a half ago, and they run some back tests and stuff and do see the 4-year cycles, but they have no concept of or no mental baggage or PTSD as well, if some people might say, of a 4-year cycle. So I think the structure's changed. It's not, we're going to be more correlated to the broader risk on and off environment in the markets.
Yeah, so we got a good question from someone anonymous as well about how do we underwrite the smart contract risk when it comes to Plasma? What happens if we get hacked? How do we manage the hedging of the airdrop, etc. Yeah, so when it comes to Plasma, it was a very plain vanilla kind of smart contract built on Veda, I believe, which has secured billions on chain, audited, etc. So it was just a pre-deposit vault. Stablecoins basically just sat there for a month before we received the airdrop. So very low risk in our assessment when it came to Plasma. And then there was a pre-market for Plasma tokens as well, where we could hedge. So that worked out really well. And in general, when we receive airdrops, etc., we don't want any market exposure in the market mutual fund. So we either hedge or we harvest the rewards we get and sell them for more stable coins. So that's how we manage that.
Yeah, hopefully that's answered the question. I think for people that are not in the industry, they might not fully grasp it, but feel free to send an email to us, and I'm happy to put it in bullet points. It's sort of unique to a crypto industry, how that works. Consider it like a pre-IPO roadshow that investment banks run, where you effectively give them money and you get an allocation to the token. In this case, the money was basically parked in custody in a smart contract with zero risk, close to zero risk, because it's a very vanilla smart contract. And in return, we got tokens. So it was as simple as that. We would never do anything, to like riskier on that front in terms of pre-deposit campaigns. So yeah. And I mean, one of the final questions is, what is the outlook for 2026? I think it's you have seen crypto underperform the equity markets. I think everything's gone to an all-time high, including gold. Yields are also coming down. Crypto market has lagged a little bit. There's a couple of reasons for that. It's because we ran pretty hard leading into the election. And people forget that Bitcoin's still 6x from where it was 2 years ago. So I think a lot of people expected Bitcoin and the crypto markets to be higher. But there was a lot of, we basically front ran a lot of the rally. And I think 2026 is going to be very, very positive as well for crypto going forward, because we've got all the other market structure builds and everything else in place, along with there's over 20 ETFs around the world for Bitcoin, Ethereum, now even Solana. And I think there's about 50 ETFs coming into the US over the next year as well. So we've seen XRP and Hedera ETFs, Litecoin ETF, and I think there's about 50 more coming. So more money coming into an asset class is always positive. And as long as we remain in a risk-on environment, crypto will continue doing well in 2026. And I have no reason to believe there's going to be any crazy risk-off environment with Trump in office and the midterm elections coming next year.
We got at least one more question. So if you have any last questions, please put them in before we wrap up. So we got one question. Does Apollo's Midas Vault share the same investor protection fund terms as Apollo Market Neutral Fund? Would you prioritize redemption for either side of the investors? So Midas, which is a European issuer of tracker certificate, have issued a certificate that tracks Apollo strategy. It's not a market neutral fund as such, so it's separate structure, separate legal protections, fund terms, etc. Find out more on midas.app/mapollo if you want to find out more about how that works. The redemption schedule is different as well. The Apollo Crypto Market Neutral Fund is a monthly redemption application cycle. The mApollo tokenized yield strategy by Midas is daily liquidity schedule. So there are different products, and the tokenized yield strategy is issued by Midas. I think that wraps up the seminar. So if you are not subscribing to our newsletter, please go to apollocrypto.com. And thank you everyone for attending today. And we'll see you at the next webinar.
Thanks, guys. Bye-bye.
Thank you.